You might be thinking about buying a home in the next couple weeks or months, but you've been deterred by the current state of interest rates. Well, what if I had a couple solutions for you? Let's get into the video. Hey, if this is your first visit to the channel and you're looking to learn all about the New Jersey suburbs of New York City, then please consider joining our Subs of NYC community. We'd love to have you. Hey, I'm Jeff Massey, your local Midtown Direct Realtor here in the northern New Jersey area. And I'm here to be a resource for you on the ground as you're getting to know the area, finding suburbs and towns that you might be interested in, and learning more about the purchase process. Let me help you strategize so you can make an easy, stress-free purchase. All right, so let's get more into the details here. So as you know, we're in a weird market right now, and that's generally due to a couple different things. The first one is supply. Now, supply comes in two forms, and I've talked about this before, and you might have seen it in my email from a while back, but essentially supply is lacking because of the fact that we're not building enough homes. So there's sort of a systematic or a systemic issue there where we're not actually keeping pace with population growth. So you're seeing an issue where over time we're actually millions of homes, on a national level at least, we're actually millions of homes behind. And you can see where New York State and New York City and the surrounding states and counties are trying to keep up with pace, but they're having difficulty simply because of land and resources and developers that might be interested in this type of thing. Now, the second part is obviously tied to interest rates. It's sort of interest rates being a proxy for demand. The Fed is trying to tamp down interest rates, obviously tamp down demand, and that's affecting sellers who have really good interest rates from a long time ago, and they don't want to go on the market because basically they're going to have to buy into a higher interest rate. That obviously doesn't seem very interesting to them. So between those two items, we're having a very, very short supply of inventory, and you can see that in the volumes that are going on today. But what does that mean for you as a buyer, and how can we start to alleviate that? Well, interest rates, we're going to be talking more about how we can try and bring those rates down in the short term to make it more interesting for you to think about purchasing. But the other thing we want to talk about is the general environment that we're in, because essentially there's a lot of people sitting on the sidelines, maybe a lot of people like yourselves, and they are waiting for this perfect storm. They think the market's gonna tank, and they think interest rates are gonna come down and they're gonna get this amazing deal. Well, I'm here to tell you, unfortunately, you're waiting for the wrong event to be happening, and you're probably going to be waiting for a long time. So essentially you're going to miss the boat. As they say, the best time to buy real estate is yesterday, and that's not exaggeration in this case, because as I'll talk about a little bit later, as interest rates do come down over time, you're going to see a surge in demand that is already actually pretty strong considering the amount of inventory we have. So when you pair low inventory with high demand, obviously you've probably taken economics, you can assume and understand that we're gonna see even higher prices in the future. Now you're probably saying, Jeff, where are you getting this information? Everything I'm hearing is market crash, recession, this and that. Well, you have to think about the fundamentals. Like I said, there's very low inventory. According to a recent Goldman Sachs study, actually 99% of homeowners who have mortgages have interest rates less than 6%. And somewhere around 28% of those have less than 3% interest rates. On top of that, 42% of homeowners actually own their home in cash. It's pretty crazy to think about, but when you factor all those things in, they don't want to sell because of those higher rates, of course. Basically, what all of this means is that the market is actually very strong, contrary to popular belief. That's because the fundamentals are underpinning these values. Yes, they're going up, but it's because there's not enough supply to meet up with the actual amount of demand that we have. So back in 2007 and earlier than that, when we saw the downturn, essentially what was happening is you had a lot of subprime mortgages, you had a lot of foreclosures on the back of those, and you saw an influx of supply and not enough demand to keep up with it. And you saw a market crash, quote unquote. But in this case, we don't have that. There's no underlying big stream of foreclosures that are coming in. If you're seeing headlines about that, they're just comparing it in the short term to the pre-COVID levels or pre-pandemic levels. So yeah, there was more foreclosures before COVID, but when you look at the overall graph, it's actually quite low. But anyways, I'm rambling on here. What I want to get into is two topics. The first is called a rate buy down. It allows you to lower your mortgage rate in the short term for 2 years. And then the second one is called an interest-only loan, which I'm sure you've probably heard of. Now, these are two instruments that can help you lower your payments, because we're talking about payments. When it comes to buying a home, you're not really buying it for the price, you're buying it for the monthly payment that you can afford. And that's obviously passed along through the debt to income ratio that you're getting from your mortgage loan officer. So think about it from a payments perspective, and that's what we're gonna look at when we jump into the Excel file here. The other thing that we'll go into detail on is how this impacts future values. If you were to wait and see what the mortgage rates are gonna be in a couple of years, let's say they go down 2% over the next 24 months, how would that impact you and your buying power if there's a surge in demand and market values actually go up instead of down? So let's jump into it and talk some more. We've got Excel set up here. I'm gonna walk you through the numbers between owning without a buy down and owning with a buy down, and show you what the savings is and actually how it could actually get you into a pretty comfortable position if you're worried about your monthly payment. So let's first look at a home, and I've simplified this to a loan size of $1 million, which is of course a jumbo loan. It doesn't really matter what size loan, but this is just a nice round number. Now, if we're backing into the home price, that would be a home price of $1.25 million. Your down payment would be $250,000, and your loan would be $1 million. So in today's rate, let's just say it's 7.5%. It could be a little bit less, could be a little bit more, depending on the day you're watching this. But the monthly payment would work out to be just under $7,000 in that scenario. Annually, you'd be paying about $84,000 annually. Now, if we did a 2-year buy down, that means you've got 2 years of buying down the mortgage rate. The first year you buy down from 7.5% to 5.5%. So you get 2 full percentage points down, or 200 basis points as it would say in finance. And that would give you a mortgage rate of $57.80. Now, the other thing I took into account here is, in this case, we're gonna be opting. We can talk about how that works in terms of net and gross, but really, let's just assume we're gonna pay the cost and build it into the mortgage as a seller's concession. And again, these are all terms that we can talk about offline independently on private calls, but this is really to deal with the fact that it does cost something. So in this case, it's 2.25%. Last I checked with one recent mortgage loan officer. So that's going to cost $22,500. Now, keep in mind, you're only going to be paying for 20% of that. So I financed 80% of this into the loan. You're going to get that back as a seller's concession, because you're going to gross up the purchase price in this scenario. So you're going to end up paying about like $4,300. I can't remember. We'll talk about that a little bit later. Well, $4,500. I have it right here. So that's going to cost you out of pocket $4,500 extra on top of your $250,000 down payment. But what that does, like I said, is it's buying $57.80 instead of $69.92 in monthly payments. So that's a difference of $1,200 a month, or almost $1,500 a year in your first year. So then going to the second year buy down, we lose another percentage point. So now we're at 6.5. Unfortunately, it's creeping up. But keep in mind, you could refinance depending on if and when rates come down. If they come down faster than we're expecting, then maybe you refinance before you hit year 2. But let's say things are still a little high, you stick it out and you go with the second year buy down, 6.5%. So now your mortgage jumps from just under $5,800 to just under $6,500. So $6,434. That is a savings of $558 per month. And in that second year, that would total $6,692 in savings. So when you combine those together, adding those together, you've got just over $21,000 of savings. Now, like I said, you are paying an extra $4,500 in that down payment because we had to bulk that in. That isn't always going to be the case, because maybe sometimes the seller's offering it and we're kind of blending it in anyway, so you don't really notice it. But let's just say, for worst case scenario, we're bulking it in, we're grossing up the purchase price. So the net savings in that case would be $16,737. So right off the bat, it can save you a lot of money to do this buy down. But what I'd like to talk about is the bigger picture here, which is if you don't purchase now, in a low inventory environment with less demand, even though there is still demand. Keep in mind, there's still bidding wars going on. I had a client miss out on a deal a few weeks ago. There was like 6 offers, and so there's still people actively bidding, but the interest rates are scaring off a lot of people. That's kind of why I'm making this video. But this is the key to what I'm trying to get at here in terms of the psychology of, in the future when interest rates come down, all that pent-up demand is going to drive into the market. You're not going to see a decrease in value. You're going to see an increase in value potentially, because everyone's been pent up on the sidelines waiting to get into the market. And now those 6 bidders are going to become 12 bidders and 18 bidders. So what I'd like to pull up here is, let me unhide these slides here. And let me just slide things over a little bit so you can see a little bit better. So in this scenario here, you've got the $1.25 million purchase price. But in the future, because keep in mind, this is the wait period. Now we're in the wait, this column here, we're in the wait period. So in the future, things are going to keep appreciating, or maybe they'll stay flat, but suddenly interest rates come down and there's an uptick in interest because now everybody's pouring back in. They want, okay, interest rates are low, I'm going to buy my house. Well, what's going to happen? Like I said, bigger bidding wars more frequently. Inventory is still going to be pretty low. It's not going to be this huge surge of inventory because suddenly interest rates are down, right? Because like I said at the beginning, supply is still historically or systemically down because we're not building enough homes. So factor those two things into the equation. Not everyone's going to list at the same time depending on what the rate is. So I think what's going to happen, and again, this is just my prediction, but a lot of other people are talking about it as well. You're going to not just see a level or a decline, but you're actually going to see a premium on these homes because of that extra pent-up demand. So what I did was I created 4 columns here. What if there was a 3% premium? What if there was a 6, a 9, a 12? Now I think baked into the cake, this is 2 years down the road, we're probably easily going to be into a 6% appreciation, 3 times 2 years. And if you add in another 3% premium of bidding wars or another 6% or however you want to slice and dice this premium factor, go ahead. That's why I made 4 categories here. But what it's showing you here is now you're going to be purchasing, instead of $1.25 million, you're going to be purchasing just under 1.3 million, and a 6% a little bit over 1.3 million, and then all the way to a 12%, all the way up to 1.4 million now of additional value that had you just bought now, you're probably going to save that money. So that's a difference of 30 grand right off the bat in down payment. I didn't add that row here, but 280 minus 250, that's 30 grand. You'll see when we get down to the bottom, when we include the first year payment, there's definitely a large savings there. So okay, so now let's play out the loan, right? Okay, well now you've got a 5.5% interest rate. Rates have come down. Everybody's happy, right? So you're getting that $5,800 a month, actually $5,850, let's say, in the pessimistic scenario that rates or that values stay pretty level. Annually, that's $70,000. But let's go back now in our original scenario where we paid less, but now we're refinanced. We're back at the 5.5%. Now we're paying $69,000 a year. So you're saving it's pretty negligible, right? It's less than $1,000. But when you factor in the down payment, you're at about $8,300 a year of savings. Now that's at the 3%. If you go up, you can see 6%, you're at $17,000, almost $18,000. 9%, you're at $27,000 in the first year with the down payment and the savings on the mortgage price. And then if we're in this crazy scenario, and this could be anecdotal. One house might just be a 3%. Maybe it's not as attractive as a house, but it did appreciate a little bit. Whereas then the other category here in the J column, 12%. Maybe it's a very popular house. People really want that home. You see a bidding war. So suddenly, 12%, it might seem crazy, but it's not. Trust me, you're going to see these as we talk and show you comparables. So now we're up to $37,000 in saving in the first year, and then that's going to continue on $7,000 a year in savings. And that's just if you refinance at 5.5%. All of this is not going to be timed perfectly, right? This is just a hypothetical. So like I said, if you buy now, you've got this savings built in. Assuming you buy the 2-1 buy down, you've got even more savings built in. So these are just the numbers, but what this isn't showing you is the psychological and the traumatic experience of having to go through something like we saw in COVID, where people, again, were in these really, really competitive bidding wars. the psychology and the added stress of dealing with low inventory and high demand is going to really make this situation of waiting untenable. So you can listen to all the gurus, everyone, there's lots of different opinions, right? They're probably just looking at the numbers. And again, this is just looking at the numbers, like I said, but the numbers here, maybe for you, if you can afford a 1.2 million house, 36,000, in the first year, maybe that's not a lot. You just want to psychologically feel like you won because you got the better interest rate. But what I'm telling you is, psychologically, the other way is going to be the stress of having to deal with multiple bidding wars, finding less inventory. And again, I don't think inventory is going to jump up that much. You might see a few people that are going to start to list. But I would get into the market now. And the other thing is we've got the winter coming up here, so we're going to see a little bit less of demand. Supply also tends to come down a little bit. But when you have another decrease of demand, that is a real opportunity for you to get into this market now, save a couple bucks compared to the 2-year, let's say 2 years is how long it takes for interest rates to come down. Save a couple bucks. Even though it seems like you're paying more monthly, with that buy down, you're actually pretty much breaking even, if not, saving a little bit. The days of the 2% or the 3% interest, they're gone for a long time. We don't know if or when that's ever going to come back. So I think the idea here in today's video and today's discussion is to swallow the pill. I know it's a tough pill to swallow, that those rates are gone, but look at the situation and do yourself a favor for what might be coming. Okay, but there's another option that I didn't talk about in terms of financing. I want to go back here and just scroll down a little bit. And that's the interest-only option. So say you don't like the idea, or you can't stomach the idea of paying an extra $20,000, building that into your mortgage. Well, there's another option if you can qualify for it, and that's an interest-only loan. So in this scenario, and typically, let me just give you the breakdown of how those work. What it typically is based off of is a 10-year interest-only period. And again, you have to get pre-approved with the bank to see if you can even qualify for this, because it might require a different debt-to-income ratio than what you would just make on your regular amortizing loan. But let's just say you qualify. Like I said, you'll have to check. Instead of paying that $2,200 or $22,000 extra in the premium for the rate buy down, let's just say you do interest only. So that's a 7.5% loan. Now it could be slightly more because interest onlys usually are a little bit more expensive, but let's just keep the numbers level here. In that case, you're not amortizing. And keep in mind, you're not really going to be paying that much in amortization in your first couple of years, because the way the calculations work, it's front-loaded towards interest and then amortization later. So you're paying a little bit each year in amortization. So let's just say, okay, we're not going to be paying that much in the first couple of years with this high interest rates. So in this case, we're looking at $6,250 compared with $6,992. So that's a monthly savings of $742 and an annual savings of $8,900. So that could be an option for you if you're trying to avoid high monthly payments right now. Every buck counts. The $742 could go towards groceries that month, or maybe a nice dinner out once a week. But let's look at it from that perspective. That saves you the $22,000. Assuming rates come down before the amortization period in year 11 starts, you could then refinance. Like I said, hopefully 24 months should do the trick. But again, no one's a mind reader here. We have to pick our battles where we can. We have to make some assumptions in order to project forward. Because again, housing is a need, right? You need to live somewhere. You need a certain size space based on your lifestyle and either your family or your partners, whatever it is. You need a certain amount, and you've got to live somewhere. So the alternative to this other part that I left out is if you keep renting for 2 more years and saving up, you're paying all that rent to the landlord. So at least in this case, you're renting your money instead of your house. And so it does kind of stink to pay that interest only, but at least you're saving that amortization that you can be reinvesting in something else. So as usual, I hope you found that helpful. If you have any questions, feel free to reach out to me. I know this is a very detailed topic and there's a lot of nuance to it. So I'd love to strategize with you directly and learn more about what you're doing in your current search or your potential search, as we say. Hopefully this video changes your mind and maybe opens it up to the possibility of saving some money with one of these interesting financing tricks. As always, thank you for letting me into your home, and I hope that together we can help find your next one. In the meantime, we'll see you in the next video.